Well, thank you very much for inviting me. It's really good to be here. Only reason for questions being towards the end is I'll try and make sure that I'm as specific as possible and cover enough of the ground. But yeah, if there is anything that you desperately need to ask, then do. Bit of background on me. So I am head of co-investment at Guinness Ventures. I joined a year ago. My background is in financial services, but a different area. So I actually started out in equities, spent 25 years or so doing that. And the journey was leaving JP Morgan to go into a startup, which we listed, never took venture capital, and eventually sold to a big Chinese broker called Haitong. And over that period, I divided my time between London, Tokyo, Hong Kong, and then came back to London just before COVID. In a CEO role with the same firm, but very dull by comparison, much smaller team. And I really wanted to move into a more entrepreneurial setup again. So I took a job raising money for companies. So I know exactly how that feels. From 2022 to 2024, which obviously felt like the worst 2 years ever, but it got even worse in 2025, I think. And then I joined Guinness in May 24. And just in brief, the co-investment service is a service that can only invest alongside Guinness deals. So it's when Guinness is invested in a business, I can open that up to a book of high net worths and they can co-invest. Just to be clear, sort of what that is, because co-investment can also be investment between funds. And what else? So about Guinness Ventures specifically, first thing to say is nothing to do with the pint. That is Diageo and not a family office, because those are two common misconceptions because of the name. So we are a Series A focused venture capital firm. We invest in consumer, tech and health, business services, real world businesses. And we back companies which are usually UK based because they have to be EIS eligible. And they are generating $1 million of revenue over the last 12 months. So those are the key criteria, and they are non-negotiable. That's part of our investment mandate. If anyone saw Christiana talking last week, Ollie, I thought that was a great session. She's been absolutely brilliant on all things EIS. So I'll touch on it, but I won't go into huge detail. I'd probably just direct people back to the expert. But that was a really good session. So I think probably the first question to answer is the question I was asked to answer, which is, what do VCs actually look for? And I think in my journey to VC, because I'm relatively new to it, I think the thing that really struck me is the difference between venture capital and angel investors or small family offices is that VCs are businesses and they invest other people's money. So that is a really obvious point, but it does dictate what we can do and what we can't do. And it tends to mean, which we'll come on to, that we are much more focused on numbers, metrics, than we are excited about the vision and the product. And that's something to think about when pitching. We are quite focused on the sort of P&L, the financials. So if that sort of sets the background, I think probably useful to go for what we look for and maybe what we don't look for. So the first thing, there are sort of 5 key criteria, and I don't think any of these will come as a surprise. But the first is founders and teams, your experience, your background, whatever you can bring to the table to say why your business is likely to succeed. That's extremely important. Also, if we do get on a call with you, because the first point of connection is probably going to be a deck, just how you interact with us and the way that you answer questions shows us quite a lot about what you've done and what your journey's been like and how familiar you are with the process. And just bear in mind that we're Series A, so we're later. So some of the companies that we see will have actually raised quite a lot of money already and be very well reversed and well rehearsed. Others will be coming in for the first time. Commercial traction. So because we have to have $1 million of revenue, that means that you've got product market fit, you've sold successfully to customers. So you've got something which hopefully is going to generate repeatable sales. Market and scalability, this is always a big one. we're not looking for blow the doors off unicorn. We're looking for about a 3 times return. So if you can look at your revenues today and then think about how big those revenues need to be at exit and what the gap is between the two, in terms of valuation, the valuation, you should be able to justify your company being worth about 3 times more than we paid for it on the way in. Business model and edge. So that there's lots of ways of looking at this, but differentiation is quite key. How are you different? Why now? All of those questions that you'll probably have come across before. And then how do you protect your position? So if you're a tech business, have you protected your IP? If you're a consumer business, maybe you've got to think about brand. Regulation is key. And then exit visibility, I've just touched on. It's a really tricky one. There's lots of confusing messaging because VCs operate at different stages. Pre-seed and seed might say, oh, never talk to us about exit strategy. It shows that you're not committed. Series A, we are thinking about exit strategy because you might be with us for 5 to 7 years, but we're still thinking ahead to what we can sort of grow the business to with you in order to achieve an exit, because an exit is what returns the value to the shareholders and to you and to us. So that's kind of key in terms of what we do invest in. What we don't invest in at Guinness is deep tech or life sciences, mostly because they take a long time to come to fruition in terms of commercial product. And also we don't have the technical expertise in the team. We can't look at pre-revenue businesses, obviously, because we have to have million plus. And we tend to be a bit shy of capital intensive models. We don't tend to do very heavy asset-backed businesses, which lend themselves more to debt funding, say, than equity funding. But we do like companies that are already selling a great product, they're ready to grow, and also where they're ready to accelerate the business. So one of the difficulties for founders, obviously, is the funding environment is really tough. If you're running out of runway and you go to a VC, they're very unlikely to be able to invest in you because, that runway needs to be in place before you come. So people's views on this differ. If you've got more than 6 months runway, if you've got 8 to 12 months runway, that's probably quite healthy. But it is one of the difficulties with VCs. You can't come when you're, towards the end of the road. Now I'm just going to talk about sort of, is your business ready for investment? What does that mean when you get on a call with us? What gives us comfort? So again, Series A, so you're going to have revenue, you're going to have margins, you're going to have commercial traction. So knowing those numbers as a founder off the top of your head is really key, and probably being able to talk about them in quite a lot of detail. So even if you have a great FD, a CFO, whatever, the founders also need to be on top of it. And the monthly revenue numbers, all of the things that we would expect you to kind of live and breathe, those will be gone into even in the first call. So revenue margin metrics, depending on your type of business, like customer acquisition cost, lifetime value, your cash burn, your runway we've talked about. These are all really good things to prepare. And then repeatable growth, again, if you're a B2B business, that's easier to look at. But are you seeing consistent revenue? What's your churn rate? Are sales repeatable? What's your contract length? Are these multi-year contracts? Are they short-term? That all gives us an idea of how much revenue that when you look at your forecasts, you can actually predict for next year with a reasonable amount of certainty. And so that's key, because if you're coming to us at 1 million and you're saying, I think next year revenue is going to be 2 million, and you've got some visibility over that 2 million, that's really helpful. And then fundraising materials, again, people, lots and lots of different views. I mean, we just like to see a deck, and we're not particularly prescriptive on length. It could be 15 slides or 30, as long as it's really clear from the outset who you are, so the team, what you're asking for, and what you do. And I think the what you do bit is very important, because the clearer you are, the simpler the explanation, the more likely it is that we'll carry on reading. A personal sort of thing of mine, because I spent 25 years, the company we built was research. I flipped to the P&L pretty much straight away. So don't bury it too far back. And it's really good to have that looking quite detailed, because the way that your financial model put together, if you are Series A plus particularly, will be quite sophisticated, and it gives us a really good idea of how your business is working, but also what your expectations are and whether those expectations to us look achievable. And that will be in the context of all of the other businesses that we're looking at and have looked at historically. So we should, I hope, have a relatively good idea of what achievable looks like for your type of business. If we've never looked at a business like yours before, that's not a bad thing necessarily, but it might mean that we're less sure of how to measure or how to work out whether your estimates are looking reasonable. But it is a really critical part of the deck. The final thing I'm going to talk about, we'll open up for questions, but the final thing I'm going to talk about just briefly, as I said, Christiana did a great job on this last week, is EIS eligibility, and why that's non-negotiable. So for us, the way we deploy capital comes in to Guinness Ventures from retail clients. Effectively, it comes in from wealth managers who manage high net worths, and to some extent from high net worths directly, but it's all money that belongs to people, not institutions, and they want the EIS benefit. I'm sure everyone knows this, but what does EIS do? It's one of the best things I think the UK did. But sort of standard EIS is that if I'm an investor and I invest in your business and you have EIS, and I can hold that holding for 3 years, then I can take 30% off my tax bill in the year or the year prior. So it's an incredibly nice incentive for me. It reduces my risk. And also, if the business doesn't work out, I might get loss relief protection as well. So EIS is very powerful. For founders, it obviously makes you much more fundable. Even if someone doesn't want your EIS, they're an overseas investor, you might want to use it for a mix of investors. So you might want to have UK investors and non-UK investors, and the non-UK investors don't take up your EIS, but we do. But obviously it does open up the doors to a vast array of funding, including family offices and people. And then standard EIS, you've got the ability to raise up to 7 million normally. You've got the ability to raise up to 12 million normally over 7 years. We're going to have a webinar on this, but knowledge intensive EIS, even if you're an early stage business, have a look to see if you can claim it, because that gives you the ability to raise up to 20 million over 10 years. And it's a different pool of funding for some VCs. So for us, we have a knowledge intensive fund that we can invest from. And that's another pool. So have a look at it. If you've got R&D tax credits, then you've probably got quite a good chance of becoming knowledge intensive eligible, and you can use those to support your claim. But you have to get some specialist advice, but it's not particularly expensive. So that is a powerful tool if you have a business that's tech heavy. So just to summarize, so in terms of Guinness itself, so Series A, million of revenue, EIS, real world focus. So we quite like things that we understand and touch and see. We're unusual in consumer, and that we also do D2C or B2C. And we typically are looking for companies that are really ready to make that next jump. So they've got 1 million of revenue or even 5 million of revenue, and it's all about making the transition into high growth. And I should just say, high growth for us, if that gives an indication, in the very early stages, you might be growing 100% year on year or more. But consistency over 50% to 60% growth year on year is what we're looking for. And the advantage of coming to a VC is that we can reinvest. We follow on. So we want to invest in you again. But in order to be able to do that, we've got to see that growth rate continuing. So it's really important for us. We're very, very focused on revenue. It doesn't matter if you're in loss or you go deeper into loss in order to generate the revenue. That's what we focus on. So that's another characteristic of VC, which is a bit different, and probably quite a key distinction between raising from a VC as opposed to, say, a family office that's looking for profitability or a positive EBITDA. We don't require that. So that is an outline. I know there's lots of information there. So I was going to open it to questions at any point, or I can talk a bit more about any of those sections.
Lisa, thank you very much for that. Now, there's got to be some questions in there. Go on, Mike, and then Andre.
Thanks, Ollie. Thanks, Lisa. It was interesting to hear. We're not quite at the million revenue. In fact, we just signed our first client for 10K, so we're some way from that yet. But my question was that we want to accelerate fast. We want to grow fast. We've got our vision for we're currently raising SEIS now that we're onboarding paying clients. We got an angel last year. We're now completing our SEIS round. We plan then to raise seed in H1 next year, and then we'd probably want to get to Series A within perhaps 2 years of that point. I guess my question is, do you look for a pathway like that's accelerated like that, or are there any kind of red flags in there that you're already thinking?
It's a really good question, because we look early. I mean, the brilliant thing is, and we have this great system. Affinity is the platform we use, and essentially what happens is, if you were to send your deck in today, which you can do in a type form, or you can, I mean, you're on this call, so you're very welcome to send me something. We put that into our system. It's a CRM, and then it will say too early, but it sits in there, and then you can come back and say, right, here's the update, or you can email, or you can send whatever you want. And if you're showing nice progression, we are immediately more invested, as it were, in watching your journey, because we've seen you before, and we like the look of you. I mean, obviously, if the business is not something that we do, then we know that early on. But if it is something we do, you've actually given yourself a bit of a head start, so it's worth doing. It raises another question, which I think, and this is all from my own learning of coming into VC. I've only been in the world of VC for a year, and prior to that, I was sitting on the other side going, what on earth do they want? I'm raising money for company. I don't understand. So the other thing, which I think is interesting, is if you take the pathway you're taking, it depends what you do with your valuation, because the temptation sometimes, and companies at an early stage all have to think about this, is you're trying to value your company, your business, and obviously as you're raising funding, you don't want too much dilution, so you want your valuation to be higher. And if you've got a kind of business that an angel loves the look of, gets really excited about, and you say, well, look, my valuation is 30 million, and they go for it, and your revenue is 500,000, you're going to cut yourself out of fund land, because unless something amazing is happening, a fund will be having to buy you at the right price, get in at the right price. So the only real point of divergence is if that happens and you get these disconnects between valuation and stage. So I think what you've described, I mean, as long as I don't know what your sort of thinking is, but as long as you have that sort of nice progression and you're able to come to a VC and say, look, my revenue is now 1 million, I'm pricing myself at 10 or 15 million, but there's a really good reason, because my revenues are jumping to 3 million next year, that's still fine. But if you were at 40, it might be an issue it would be an issue for us.
That makes sense. Thanks. I think the key is trying to build the relationships as you go and build them early so that you find whether or not you're a good match.
Yeah, and also thinking about what you want the capital for, because I don't know whether I'm going to get asked this question, but one of the things that I found surprising, and I really had to think about, was that when we charge fees, so not all funds charge fees to the company. they charge to the investor, but companies will quite often pay a transaction fee on the money raised. So just, I don't know whether this is a topic that gets openly discussed, but if you are raising £1 million, £1 million is very unlikely to land in your bank account, because the fund can charge a fee, there'll be due diligence costs, there'll be legal costs. So make sure that you build that in. The advantage of going to a VC is, despite the fact you get less money because all these fees come out of it, you've got a much bigger chance of raising afterwards, because A, that fund is on the hook, and B, other funds know that that fund's done the due diligence and likes the look of things.
Thank you very much, Mike. Now over to Andre, then Paul.
Hi, Lisa. How are you? Thank you for your time. Lisa, I run a prop tech platform, and been in the industry for over 25 years. We raised 150,000 under SEIS, and we are now EIS eligible as well. However, our platform has gone through a couple of transitions over the last sort of couple of years, and is not currently income generating, but will be with our new platform launching in September. It will be income generating pretty quickly. So we've got all the customers ready to onboard, and it's all ready to go. My question to you really is, you look for £1 million in revenue. Do we have to show to you £83,000 a month over 12 months? Or if we come to you in 6 months' time and say, right, we've been generating £100,000 a month for the first 6 months of this year, this is our estimated growth for the next 6 months, would you look at us then? Or do we have to be income generating for a year before you consider us?
So the actual requirement is the lowest level, £1 million ARR, which, as you know, is a deeply fudgeable. Bye, Ollie. I know you've got to go.
Have a great weekend all.
Thank you.
Cheers, Ollie.
If everyone's okay to stay on, I mean, we can carry on. But the issue is, the reason I tend to say last 12 months revenue is because of the competition you're up against in our cohort. That's one thing, and also very early stage businesses, in terms of, even if you've been around for a bit and you've pivoted and you're generating the revenue, as someone who's been in their own startup, it's incredibly difficult to predict. So the repeatability, the metrics, all the things that we look for, you can't really show. It's not that your business is not worthy of it, it's just that it's really, really hard to demonstrate. So I'd say that's one reason that for us, if a business is on the cusp, then it would probably be a B2B business where they've got contracted revenue, which is significantly higher. The other thing to bear in mind, and this is something which absolutely did not occur to me when I was raising money for companies, was what you're up against. Because Guinness, and I haven't actually said this, but Guinness invested in 11 businesses last year, and 8 of those were new, which was great, but it's still quite a small number, given if you think we're looking at 12 to 1,300 applications in a year. So we're looking for a very small percentage. Last year's cohort, the average revenue, so between all of them, was 5.1 million. So one of the biggest new investments that we made, they already had 12 million of revenue, and they bootstrapped.
Yeah.
So it's kind of, then we're going, well, hang on, we've got someone at the 1 million, or just coming into the 1 million.
Right.
It just gets harder to compete against that, because we're obviously minded to go for the one that's kind of looking at more secure.
I get that.
Yeah. So the other thing, as the hot tip, which I think, because I think these things are so important to know, and I wish I'd known, is seasonality is key. So I can only speak for Guinness in terms of actual, but it should apply logically to quite a few VCs. If a VC says they want to fully deploy by the end of the tax year, as you can imagine, April, May, June is not a time when we're under as much pressure. We want to get we've actually got 3 deals in the hopper at the moment, which is great. But we're not under the same pressure that we're under in that January to March period, because we've got to be closing out deals. So logically, what that means is we have a 3-month due diligence period. So we are going to be really focused in September to December. And if possible, we'll have our term sheets out by December. So when you're thinking about the raising cycle, even though it's busy that time of year, if you get something, we're all quite aligned in trying to get you across the line and make sure that you've got your money in January, February, or March. But
That's really helpful.
Yeah.
That was my next question, actually, with regards to timing.
Yeah.
That's answered.
Yeah. And you'll quite often find that people will just won't be able to talk to you at all if it's towards the end of March, beginning of April, because we'll just be focused on closing out. Lots of people go on holiday over April. Just saying.
Thank you, Lisa. That's very, very.
If
very
it's an evergreen, then it doesn't work like that. That's for funds that do operate in that way. Are there any more? Oh, sorry, hi, Paul.
Yeah, thank you very much for today. Much appreciated. It's not really a question that I have, but more guidance. One, I'm in a physical consumer goods space, D2Z, sustainability. I'm looking to become Europe's #1 shopping bag brand, which turns out is a sector that's massively overlooked and actually huge. So I've got myself on the road. I'm not in the right stage of business that you mentioned in terms of Series A. I'm sort of pre-seed with a bit of turnover. So basic proof of traction. My question is, because I've noticed a lot at my level, there's a lot of money going towards tech and AI. Higher up, Series A, there seems to be more money into the consumer goods space. In which case, do you have any recommendations, or do you see funds that are sort of focused towards consumer goods at pre-seed?
Not really is the honest answer, because I mean, I know funds because of my background, but the difficulty is the time sink bit is in order to sort of recommend to you a fund, I would have to then go and look at your business in more detail, because it's so new. It's not like, okay, well, here is, I could sort of say, well, here are 3 family offices, which I know do consumer, but then, if they only do profitable, or they do this or they do that, it cuts you out. It's kind of wasting your time. So recommendations, I mean, I think I won't dwell because I know we're up against time, but we get this question quite a lot, and I feel like someone has gone out into the founder network and said, oh, if you get hold of someone in VC, ask if they know who else. And it's better, that approach is probably more angel focused than fund focused. Funds, we don't have time to look that way and that way, really. But I wish I could. If I did, but people on LinkedIn, I noticed they do actually put out incredibly useful lists.
Yeah. The other one I did want to say, because you mentioned about logging your company with Guinness for later on. One of my biggest mistakes was not jumping on with my fundraising sooner, in terms of getting to where I was and then starting. Could I drop my deck in, even though it's completely the wrong stage? Because you never know in 18 months' time. Shall I just send it to you on LinkedIn, or?
I'll share my email address for everyone in this group.
Thank you.
Just send it to me. It will go. The safest way is to fill in a type form on the website, because it doesn't rely on me. Then it comes to all of us.
Okay.
So I can also share that link as well. Is everyone okay for time? I'm just going to say to Julian, because you've got your hand up. Did you have a question?
I'm completely not the right sort of fit for you. I was just interested in your comments about valuation, and wondered if you had any advice. I'm very early stage, sort of looking for sort of first investment coming in medtech, and
okay.
I've not had any real sort of sensible guidance, I think, on what that valuation figure should be. I mean, is it something that should be a sort of a multiple of the amount of raise that you're aiming for?
Not really. So there's lots of different ways of doing it. And the quickest way to say is the resources that you need are other founders and comps. So when you're pre-revenue, it is slightly yeah. The thing I found most useful when I was advising companies on how to structure their pitches for VCs was Bauhurst, BEAUHURST.
Oh, yes.
And
Yeah.
I think you can get it as a free resource. It was absolutely amazing. You go in and you do a search for businesses, you know, as with the stage you're at now, what you're trying to kind of grow, and you can see all of the businesses, who funded them, and each stage you should be able to see, you know, pre-seed they were valued at this, seed they raised X amount at that. I found it absolutely invaluable. So I just downloaded all of that and made a little matrix and sort of thought, okay, well, these 5 businesses that sort of look like me when they were at my stage raised at this, and then look at the year, because if they were raising in 20 or 21, valuations were massively inflated. So 22, 23, 24 is much better idea of kind of what things look like. Common mistake, I think, unless you can get away with it, is to sort of say, I'm a coffee company. I looked at Starbucks and Costa, you know, you obviously, those are your aspiration things. That's useful if you need to know how big your revenues need to get to exit. But right at the beginning, just sort of keep it fairly tight. The other thing as a founder, so switching round, is just from your perspective, try and keep hold as much of the equity as you can. Means that you're not, you know, you are not giving away everything. Don't Dragon's Den it and sort of say, oh, I'll give away 50% of my company for 50 grand or something. Otherwise, you just won't have anything left to raise. So there are lots of different ways of looking at it. But if you don't have a revenue multiple, in a way, you have more freedom. As soon as you have revenue and a revenue multiple, you're kind of in this path. And that's a bit more regulated, if you like. So comps, sort of calculation on dilution, equity, what you need to hold on to, and then how much do you think you'll be raising over the whole period? Because obviously that will dictate how much you can give away.
Right.
It's a really early stage.
Lisa, what's your typical amount of investment if all the boxes were ticked?
It's 2 to 3 million on first investment. We can go as low as 1 million. Some firms can't because the due diligence process is quite onerous, but we can, and we can tranche it. So we can do a commitment where we say, look, we'll put in 2 million, but you can have 1 million now and then another half and another half, or we can just put the whole lot in. So if there are any more questions, I'm very happy to. So I'll share 2 things. One is the type form if people want to put their decks in, and the other is my email. Thank you very much, everyone.